A week ago, traders thought there'd be one more interest rate move by the end of the year. Now, the market is pricing in a hike as soon as October, and a second one right behind it. If you have a mortgage, a savings account, or a credit card, this affects you directly. Here's exactly what changed, why it happened, and what you should do about it.
A glowing digital line chart floating in dark space, showing an interest rate line sharply bending upward. Blue and gold light trails. Abstract data visualization.
Just last week, futures markets were pricing in one rate hike, expected around December. That's it. One move, months away.
Then, almost overnight, that changed. Traders are now pointing to a hike as early as October, with a second one likely to follow in the months after. That's a much faster and more aggressive path than anyone expected going into the summer.
So what flipped the switch? Two things are driving this. First, inflation hasn't cooled the way policymakers hoped. Price pressures have stayed stubborn even as the broader economy holds up better than expected.
First quarter growth was actually revised upward, and manufacturing activity has now expanded for 6 straight months.
Second, there's a new voice at the top. The Fed's leadership has become notably more hawkish under its new chair, signaling a willingness to move faster and harder against inflation than the previous approach. Put those together, a resilient economy that isn't slowing down inflation on its own, plus a Fed leadership more willing to act, and you get a market suddenly repricing for faster hikes. Not everyone at the Fed agrees on timing. Some officials have pushed back, arguing the inflation data alone doesn't yet justify moving faster. But the market is clearly leaning toward sooner rather than later. Let's break this down into what actually matters to you. Rate hikes generally push borrowing costs higher. If you're planning to buy a home or refinance, a faster hike path means less room to wait for lower rates and more incentive to lock in terms sooner rather than later if you're already shopping. Most credit cards have variable interest rates tied to the Fed's moves. A hike this fall would likely mean higher APRs on any balance you're carrying, which makes paying down high-interest debt now more valuable than usual. Here's the silver lining. Higher rates are good news if you're a saver. High-yield savings accounts and CDs tend to offer better returns when the Fed raises rates. So this is actually a good window to shop around for a better savings rate. Similar story to mortgages. Expect financing costs to tick up on any new borrowing, so if a big purchase is already on your radar, timing matters more than usual right now. You don't need to panic, but here's what's worth doing this week. 1. If you're carrying credit card debt, prioritize paying it down before rates climb further. 2. If you've been sitting on cash, check your savings account rate. If it's below what high-yield accounts are currently offering, this is a good time to move it. 3. If you're in the market for a home or car loan, don't assume waiting will save you money. It might do the opposite. The Fed meets again July 28th and 29th, and I'll be breaking down exactly what comes out of that meeting the moment it happens. If you want to stay ahead of moves like this instead of finding out after the fact, subscribe, and I'll see you in the next one.